Hi everyone, thank you for tuning in for another episode of Centrick Talks Property. We're joined today with our trusted mortgage advisor, Mark from Me Financial Services, always on hand to give us relevant advice. So welcome, Mark. Thanks for giving up more of your time again today. We're going to talk today, hopefully, a little bit about buy-to-let mortgages and sort of investment products. Quite a specialist and niche part of your trade, I suppose. So do you want to give us a kick-off of the difference, I suppose, between a residential and a buy-to-let and what someone can expect from those?
Yeah, I suppose there's two things really. If you're buying a house to live in, it's predominantly assessed based on your personal income and your personal affordability circumstances. If you're buying a property to rent out as an investment property, it's predominantly the affordability of that is predominantly based on how much it rents for, and the overall proposition as a business venture, if you like.
So it goes from the individual to the actual, what we class as the asset, I suppose.
Exactly. Yeah, exactly right. And the main thing is hinged on the rent. So there are some key areas that we have to consider. So you need a bigger deposit generally. The vanilla out there will be a 25% deposit. And that's pretty much standard everywhere. There are certain lenders that will tip it to 80%. But generally speaking, most investors will know that they need to put a 25% deposit down.
Putting down at least 25% of the loan to value, so to speak.
Exactly.
Okay.
The second bit to that is that the rental income will need to be sufficient to cover the lender's tolerance, if you like, or the lender's coverage figures, background coverage levels against the interest of the mortgage. So what I mean by that is, generally speaking, you would need, say if the interest payment for a mortgage, just for math's sake again, I like to give myself let myself
simple maths. Here we go again. Yeah.
So if your interest on your mortgage was £1,000 a month, you would generally need about £1,450 a month. So that's 145 exactly. So that's 145% coverage, but that really does vary depending on each individual client's circumstances, such as their the rate of tax they pay and their income and things like that.
And differs, I assume, between lenders as well, or
very much so. Very much so. If I go back to vanilla again, the very vanilla would be the coverage of the rental income, which we spoke about. There's a lot more to it than simply what I've just said. But the coverage of the rental income, generally, you would need to already be an owner-occupier. So you would already
it's a question we get a lot, actually.
So you'd normally need to own the house that you live in already. And the reason for that, quite simply, is back in the day, back in 2008, when all the credit crunch happened, people were taking out a buy-to-let mortgage, moving into it because of the rental income. It's mainly assessed on the rental income, so they might earn £10,000 a year, but they go and buy a £600,000 rental property, go and live in it, and then obviously the tenant then which is them, they lose their job and they can't afford that higher mortgage payment anymore.
Playing the system there.
Yeah, exactly. And lenders are very clever with that now. So generally they want you to own a house that you live in already to mitigate that possible risk that you might move into the property.
And I'm assuming to demonstrate a track record of borrowing and repaying the mortgage.
Helps. It all helps. But that aside, there are lenders that will do what's classed as a non-owner occupier mortgage, where you don't need to own a house that you live in potentially, but you would need to have some sort of track record that you are an experienced landlord as well. That's normally about 6 months evidence that you've rented a property in the past. Or let a property in the past.
We get a lot of people come to us, I think, that have never owned a property before. So in essence, they're a first-time buyer, but are looking already for an investment property. And that's where we have to say, look, I don't think you're going to probably qualify for what we class as a buy-to-let mortgage if you've not owned a property before or currently own one. So
it is possible. It is possible, but generally how we would get around that, but how that would be approached to mitigate the lender's concerns. A lender would, if you are a first-time buyer, first-time landlord, they would assess it on your income mainly as well. So if you had a salary of say 40,000 and the mortgage payment was going to be whatever that would be, they would assess whether or not, if there wasn't a tenant in that property, could you still afford that
the mortgage and your lifestyle at the moment as well.
Exactly. Exactly right.
And talk to us about, we've talked about minimum deposits, so 25% generally is the average. What about interest rates? What kind of interest rates are out there for if you're putting down a 25% deposit as an example? And do they get better the more you put down?
It's not quite the same as residential. So you generally have tiers in residential where it's 90%, it's quite high.
Yeah.
And if you've got 85%, it's a little bit lower.
They almost
and
step down, don't they?
Generally speaking, the two tiers are 75% or say 60 or 65% loan to value. So it's not as changeable as in the residential market. But interest rate wise,
are they slightly higher than residential?
Yeah, they will be slightly higher. They will be slightly higher dependent on the type of product you choose. But at the same time, they're not going to be astronomical. So it's quite feasible that you will easily get maybe a high one, but most likely a mid 2% for a 5-year fixed deal or something like that. So it's possible, certainly possible. And
I think a big dilemma that a lot of investors have is, do they go down the route of an interest-only mortgage or a repayment mortgage? So maybe give us the pros and cons to those options. Yeah,
so interest-only borrowing with investment properties is certainly more popular. The conversation I normally have with my clients is, it depends on what your strategy is.
Yes.
So if your strategy is you want to have a property that's got a good yield on rent, so you're going to get a good amount of money versus your costs to running that property, including the mortgage costs, you may want an interest-only mortgage. And if your thoughts are that the mortgage will, that the property will go up in value in the future, because it's not your main house, you may be comfortable that the exit for that mortgage will be the future sale of that property.
Yes.
Obviously, the big thing to worry about there is that you're not making any repayments to the capital of the mortgage, so you just have to be comfortable.
Never depreciating.
Exactly right. Now, if your strategy is more around the fact of, I like the idea of buying a few properties, and I also like the idea of my rent paying down this debt over a period of time, and then maybe having a retirement plan in the future where I've got a couple of properties that are mortgage free, potentially. As long as you've got the means to be able to make those payments with the mortgage and maybe the your own personal income, that's a valid strategy. We won't go into details of the tax side of things necessarily, but a lot of property investors I would always urge to take tax advice. Because obviously we can bring in other things about buying through a limited company and things like that as well.
Something that we'll talk about a little bit at a high level, I'm sure, but a little bit later. So it depends on your strategy a lot whether you probably choose to go down an interest-only route or a repayment route. But again, a conversation to have and an informed decision, hopefully, off the back of that.
Most investors have got a different stance where it comes to a house that they're investing in rather than their lovely family home that they want to live in.
Of course. It's a calculation rather than a heart-driven decision. Okay. We touched on there buying in a company name or a limited company. We saw this come around a lot the last few years where you can't offset the interest in your tax returns as much as an investor. So talk to us about maybe why somebody might want to do that and the benefits around buying in a limited company. Definitely first of all, get yourself a good property accountant. Speak to your accountant. That's my first step. So from that perspective, we will have a conversation with the client. The reason you would buy a property through a limited company is, as you said, you can offset the interest potentially against the rental income that you receive on the property if it's for a limited company. Whereas when the Clause 24 changes came out, which you're talking about, that obviously changed. And I'm no accountant myself, but the conversation that a good property accountant will be talking to you about is, if you are on the cusp of being a higher rate taxpayer, and all of a sudden you're buying another property that's going to be renting for say £1,400 a month or £1,000 a month or whatever, and your plan was to build up a property portfolio, if most of that rental income is treated as personal income to you on your tax return, it's going to push you over the income tax. You could become a higher rate taxpayer. Whereas the situation may be more favourable if it was in a limited company, because you could have different parties to that limited company. You could take drawings from that limited company potentially. Drawings, you could take a salary from the limited company or dividends from the limited company, or you could have the money build up. And there's also as well benefits of if you're gifting the money, if you like, or you're putting a director's loan into the company, there is tax advantages of doing that as well, and how you get the money out in the future potentially. The key is to get yourself a good accountant, property accountant, give you some really good tax advice.
Definitely so. I mean, whenever I've got a client that's on the cusp of being a high rate taxpayer and they're like, Mark, I want to get myself 15 properties, further down the line, I would always say definitely speak to an accountant first, just to make sure, because they will look at your individual situation and how it's actually going to be affected by the growth of your portfolio.
Okay, brilliant. And then in terms of, obviously we talked previously on residential mortgages about the term of the mortgage. Is there any limitations on how long you can have that term over, which ultimately will impact on the monthly payments?
Yes. So if it's interest only, you can have the mortgage over 3 years or 150 years, and it won't make any difference to the monthly payment. Right, it's purely interest only. Yeah. But the term of the mortgage is less concerned about when your retirement age is or your ability to pay the mortgage over that term, as it is based on how long you could rent it for, or how long you're going to own the property and rent the property out for. So what I mean by that is, you may have a client that we may have a client that say is purchasing a property and they think, well, this is going to supplement my retirement income personally down the line. A lender would be quite comfortable potentially to go up to the age of 75, 80, 85, or maybe even beyond for the right circumstances, because it's not the client that's paying that mortgage payment back, it's the tenants that are paying that mortgage payment back. It's the rental income
being produced from the asset. Yeah,
exactly. Yeah. Okay. Obviously, if you have a repayment mortgage, the shorter the term, the higher the monthly payment's going to be. The longer the term, the lower the monthly payments are going to be. Okay. And we'd have that conversation about what your strategy is.
So again, it sounds like a good discussion to start with someone like yourself to talk about strategy, type of product that you choose, interest only, repayment, the term, maybe get yourself some tax advice, or before sort of starting to get into property investment.
Yeah, definitely so. Yeah, definitely so. Brilliant. I think the main thing to think about is we'll have a proper sit down about it and find out what your strategy is, and then we'll put things in place to make that happen.
Yeah. Okay, brilliant. Well, guys, I hope that's been really useful. Buy-to-let investment, bit of a dark art sometimes people think, but obviously Mark can definitely help you guys out. So if you want to get in touch with Mark at Me Financial Services, then do give us a shout and we'll be happy to put you in contact with Mark and his team. But any more questions, just drop us a like or a comment and we'll be happy to help. Cheers, guys. Hope you found that useful.
Thank you.